Hey, Jason here. Today's video I'm going to answer the question, is Ford, stock ticker F, a great stock to buy? This is stock analysis for PicknickingPillowcase, who requested this on YouTube. Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay, if you see my other videos, I apologize for this. I don't want to do this, but I have to do this because every time I don't, I get nasty comments on YouTube. I do not short sell ever. So any stock I talk negatively about, I don't benefit from. I also do not own any stock in a long position in any stock I talk positively about. So I don't benefit from that either. These are done for your informational purposes only, to help you learn how to evaluate stocks better and faster. So you spend more time looking at potentially great investments and less time looking at potentially crap investments. These are also analysis videos requested by viewers, and oftentimes I don't know what the company does. Unlike today's company, I do know what they do, but most cases I do not, and I purposely keep that way because at this stage of the analysis, I don't want what the company does to bias me either negatively or positively. This also means I don't care about what the company says they're going to do. I don't care what their plans are to transform the world, make the world a better place. I don't care what the company says they're going to do, or the CEO says they're going to do. I don't care about any of that at this stage. At this stage, I need balance sheet strength. I need profitability margins. I need the company to be essentially a good company. Sorry, my cat is jumping up here right now, so I apologize for that. Get her down for a second. So, with that being said, why should you listen to anything I have to say? In the first 9 years of my career, I produced average annual investment returns of 23.5%. In the portfolios I manage. This puts me just behind the great Warren Buffett when compared to the first 9 years of his career at his Buffett Limited Partnership, when he produced 24.2% average annual investment returns. My returns legitimately make me one of the best stock pickers in the entire world over the last 9 years, and I don't necessarily want to say that, but I need to say that to prove to you that I actually know what I'm talking about a little bit. So, with all that said, again, I apologize. Don't want to say that, have to say that. Let's get to today's video. Again, this is from PicknickingPillowcase, who requested this on YouTube. Okay, today we are evaluating Ford Motor Company, the Ford vehicle and the Ford car and truck company. I don't think they make cars anymore, actually, now I think about it. Full transparency, I have evaluated this company off and on over the years. I've never owned any stock in it, though. But I have evaluated this stock several times over the years. Okay, pay dividend. The market cap is quite a bit bigger than the last time I looked at it. I think it was, my memory might be off here, but I think it was somewhere around $20 a share last time I looked at it, or $20 billion market cap, and that might be another company because their market cap doesn't look like it at any point in the last 10 years was around that range. So, it must have been another company I was thinking about. I don't care about price sales ever, but this is one time the company might be undervalued, with it being at 0.46. Again, I don't care about Ford PE really at all. When I do, I want to see this under 20. So seeing this at 8.25 is one sign the company might be undervalued as well. Okay, so Ford Motor Company, for those of you who don't know or are not super familiar with Ford, Ford Motor Company manufactures automobiles under its Ford and Lincoln brands. The company has about 14% market share in the United States and about 7% share in Europe. Sales in North America and Europe made up 69% and 19.5% of 2020 auto revenue, respectively. Ford has about 186,000 employees, including about 58,000 UAW employees, and is based in Dearborn, Michigan. United Auto Workers, I think, is what this stands for, and this is a union, so about 60,000 members of their employees are in a part of a union. Okay, nothing else of major importance here. The last decade, their revenue is about almost exactly stagnant, from 136.2 billion in 2011 to 136.4 billion in the trailing 12-month period. That's not a huge surprise to me. Again, I've evaluated them off and on over the years. It's not a huge surprise to me that their revenue hasn't gone up in this time frame, because it actually did until 2018 and then start falling again. Frankly, because Ford's had a lot of problems in the last decade. Coming out of the last recession, they were having some major restructurings of their entire company and operations. They've also streamlined their vehicles they're making now. Again, I don't think they make cars anymore. They might be coming out with an EV car, electric vehicle car at some point, but they're focusing, as far as I know, unless something's changed since the last time I looked at it drastically, was they're focusing pretty much exclusively on SUVs and trucks. If that's changed, let me know. Doesn't really affect the analysis at all. It's just part of the reason why I'm not surprised their revenues have not gone up in the last decade. However, their operating profits have gone down in the last decade from $11.3 billion in 2011 to $8.5 billion in the trailing 12-month period. What that means here, with revenue being about the same, is that their costs are rising as a percentage of the revenue. That's leading to their operating profit margin going down as well, from 8.3% in 2011 to 6.2% in the trailing 12-month period. Again, same revenue plus higher cost equals lower profits and lower profit margins. That is not a good combination. Their share count has gone down a little bit from 4.111 billion in 2011 to 4 billion in the trailing 12-month period. It means they've been buying back stock. Typically, that's a good thing if the company is undervalued, which we'll find out shortly. In this time, their book value per share has gone up pretty significantly, from $1.57 per share in 2011 to $8.68 per share into the trailing 12-month period. This is a sign that the underlying intrinsic value of the company is going up over time, and that is typically a good thing. Sorry, that was my littlest one barging into the door. So, where were we? Book value per share. Okay, I already explained that. Their operating cash flow has skyrocketed from $9.8 billion in 2011 to $20.9 billion in the trailing 12-month period. That is fantastic. That means they're becoming more efficient with how their internal operations are running, because they're producing more operating cash flow from the same amount of revenue. That has led to a massive increase in their free cash flow per share, from $5.5 billion in 2011 to $15.2 billion in the trailing 12-month period. That is a fantastic increase. And again, is a bit surprising combined with their revenue going up or staying stagnant, their gross margins or their costs going up, which is leading to lower operating profits. That's a bit surprising that their free cash flow is going up. But that is because I can't really see it on here. They don't push out their full numbers here in this little profitability margin of sales chart here. So let's go on to what we normally talk about. Their ROICs have also gone down pretty significantly in the last decade, from 2011 at 20.9% to 5.5%. I look for anything above 10% on a consistent basis here. So this is not good, especially because it's fallen so dramatically. Although I can tell that their debt levels are far lower now compared to what they were in 2011, because their ROE was 282% in 2011 compared to an ROIC of 20.9%. And their ROE now is 10.4% compared to an ROIC of 5.5%. The higher ROE is when compared to ROIC, the more debt the company has, because ROE is levered by debt, and ROIC is not. So that is a good thing that they have less debt. Not a good thing that their profit margins, that their ROIC has fallen so much. And free cash flow to sales has gone up from 2011 at 4% to 11.2% in the trailing 12-month period, which we saw earlier, but that's a good illustration of it happening. I look for anything about 5% on a consistent basis here, so they do surpass that threshold in the last 5 years. So cash and short-term investments as a percentage of their balance sheet is 16.5%. That's very good. Their accounts receivable dropping significantly from 2011 to, at least as a percentage of the balance sheet, to the last quarter, from 2011 at 44% to last quarter of 17%. That's typically not a good thing. But we'll see what the absolute numbers show us. But that could be a potentially major red flag, depending on what the absolute numbers show us. They do have a decent amount of short-term debt at 18.5% of their trailing 12-month balance sheet. And they do have a decent amount of long-term debt as well at 40.6% of their balance sheet. So what this shows me, again, we'll see what the absolute numbers show, but this shows me that they have a net debt balance sheet position, again, at least based on the percentages. And I'll tell you more about what that means when we get to that on the balance sheet. Okay, this is fantastic. Their cash converter cycle has cratered from 173 days in 2011 to 110 days rounded up in the trailing 12-month period. What this means when this goes down is that the company's becoming more efficient. Specifically, they are selling stuff faster from 209 days rounded up in 2011 to 127 days rounded up in the trailing 12-month period. It means they're selling stuff about, 80 days faster. So 2.5 months faster than they were in 2011. Their inventory, though, is rising. That is not a good thing. So when sales fall, or when the sales cycle falls and the inventory cycle rises, that could mean the company is having issues with their inventory, which could lead to them having to write down or off the value of their inventory if a company has to do that. Or that might also lead to them discounting their offerings as well. If they have to do any of that, it decreases the value of the company. However, and frankly, this is a little bit confusing because usually, again, in a healthy environment, the days sales outstanding and days inventory rises or falls at about the same rate. When that does not happen, it can lead to massive problems. Again, we'll see what's going on there on the balance sheet for sure. But I do know that pretty much all car companies are having issues selling or building new cars because of the continued and ongoing shortage of microchips and semiconductors and processors that's been ongoing for, about a year now. Okay, we don't talk about this very much. Debt to equity. I look for anything under 1 here, and it needs to be positive as well, but anything under 1, this at 4.28, their debt to equity means the company has a significant amount of debt, which you can see here, and they have $148 billion worth of debt compared to $41 billion in cash. That is an enormous amount of debt. That amount of debt is more than double, about 2.5 times their entire market cap. I'll explain what that means in a second. Okay, total cash equivalents, and short-term investments make about $41 billion. On the surface, that's good because their entire market cap is $61 billion right now as of this recording. So typically that's a good thing. However, they have a ton of debt, as we saw. Okay, their inventory levels are rising. That's not good. Typically. Typically it's not good when inventories rise that much. It's risen about $3 billion in about a year. That's typically not a good thing because, again, it could lead to having to discount products. It could mean they're having problems selling their stuff. It could mean in the car industry them having to massively discount the cars, sell the discounts right off the value. If they're not selling their vehicles well, that will lead to lower revenues, lower profits, lower cash flows, if that is the case. Could be the case that maybe they're building inventory because of the shortages in microchips and microprocessors for the holiday season, which is typically a big one for buying vehicles. But as of now, that's not typically a good thing. Their accounts receivable have skyrocketed from $10.5 billion in quarter 3 2020 to $43.5 billion in quarter 2 2021. That's interesting. Oh, it's because of this. I was going to say that doesn't make any sense, but they have this other accounts receivable current down here in quarter 3 2020, 41.9 billion. And then when you look at the total trade and other receivables, they're about the same over time. Actually, a little bit lower, about $8 billion, $9 billion lower now than compared to this time last year. And again, that is typically not a good thing. If accounts receivable are falling and inventories are rising, that's typically not a good thing. They should rise or fall about at the same rate. But the massive issue here is I don't see any other issues so far or anything to talk about so far. Their massive issue is their debt levels. Typically, car companies, vehicle companies had a ton of short-term and long-term debt. Just because they're so capital intensive in the manufacturing process and the building of the vehicles and the vehicles themselves and the salaries they have to pay employees. Typically, car manufacturers have a ton of debt. This is one of the reasons I don't invest in them. They have way too much debt for my liking. However, Ford has so much debt that their total long-term debt and capital lease obligations are $102 billion rounded up, plus their current debt and long-term or capital lease obligations of $46 billion. So $147 billion in short-term and long-term debt. Their entire market cap is $61 billion. So in a real-world sense, what this means is that after you subtract the debt from both the cash, which is $41 billion, and the market cap of the company, there's still a negative value of about $40 to $45 billion. Meaning the company's shares, after accounting for their cash, market cap, and debt, their shares are worth less than zero when you include their debt in a real world sense. Does that mean that their shares are worth zero? Not necessarily. But what this means, and again, in a real world sense, is that this adds enormous amount of risk to the company. Anytime there's major economic issues, there's typically issues with vehicle makers, as we saw last year when the COVID crash initially happened. And then we especially saw in the 2007-2008 financial crisis. These car companies most of these U.S. car companies had to be bailed out. They had to restructure debt. I think GM might have even gone bankrupt to come out of bankruptcy. So this can, and frankly often does, lead to massive problems when there are problems. And again, problems always come up. So this massive amount of debt is a gigantic issue, as is their total contractual obligations. Wow. So including their total contractual obligations, they actually have $305 billion in debt, which is even more. That's even worse. That's almost 6 times their market cap. They have so much debt. That's why car companies scare me. That's why I've never invested in a car company. Because of things like this. Yes, when I say car companies, I mean older car companies. Yes, I know Tesla's different and it's structured differently, but we're talking about an old school vehicle maker in this video. And their cash, actually, let's go back. Let's put their equity. Shareholders' equity, where's that? Total equity. And actually the book value right now, even with all of the cash and debt, is $34.8 billion, but that doesn't include the total obligations. So yeah, they have massive balance sheet issues. Massive increase in trade and accounts receivable in quarter 2 2021. I would want to know what that is. They sold $12 billion worth of investments in quarter 2 2021. I would want to know what that is and what they are buying and selling kind of on a regular basis here when it comes to their investments. So this is a good thing. They're issuing debt, they're continuing to issue debt, but they're paying down debt faster than they're issuing debt, at least in the last 2 quarters. That's a good thing. Again, doesn't really matter because they're still they still have an enormous amount of debt, but that is a good sign. Okay, other than that, their cash flow statement is relatively straightforward. Now we're going to get to the valuation. And this is why you need to look at multiple metrics, especially not rely on price to earnings and price to cash flow and forward PE. I'll get to that in a second. But again, I don't care much for price to earnings, price to cash flow, or forward PE. You'll learn why in a second if you haven't seen my other videos. But when I do, I want to look at these underneath 20. PE is at 18.4. Price to cash flow is at 3, meaning according to his cash flow, it looks enormously undervalued, right? Forward PE at 8.25. These all are well underneath what I look for. However, none of these numbers up here include debt, which is why I love this number down here. Enterprise value to EBIT. Enterprise value includes both cash and debt, and since 99% of all companies on earth include or have cash and or debt, I want to know this number when I'm considering an investment. What this shows me is at 14.65 is that the company is overvalued. I look for anything below 8 to consider the company undervalued. This also shows me, when you look back at the historical record, that they are more overvalued now than they've been at any point except back in 2015. That was the last time they had a higher valuation on enterprise value to EBIT, was 2016. So even though they look to be improving their business in some respects, like with free cash flow specifically, their balance sheet is a gigantic mess. They have way too much debt for me. And that makes them overvalued on this metric, even though their PE and price to cash flow look very good. Because when I look at an investment, I want to, or I think about it as if I'm owning the entire business or a percentage of the entire business, because I am. That's what you get, or that's what you are as a stockholder, is you own a percentage of the business. So I want to know these things when it comes to debt and cash levels and balance sheet strength and safety and all of this when considering investment. Ford has way too much debt for me. First of all, that's the big issue. For me, the biggest issue is they have way too much debt. And that debt directly affects their valuation, which makes them overvalued when you consider the debt. And you should consider the debt in the valuation. Pretty much always, in my opinion. You should always consider the debt. Actually, I can't think of a scenario where I don't consider debt in a valuation, even on private businesses that I'm looking at and commercial real estate that I'm looking at. This goes for stocks as well. I can't think of a scenario where I don't subtract debt from the valuation. Again, private business, public stocks, commercial real estate, I always subtract debt because I don't I don't like a lot of debt. So, and that again really truly affects the valuation of the company. So, problems with the company in terms of revenues, stagnant revenues, generally falling margins over time, other than free cash flow to shares or to sales. Balance sheet is a mess. They have way too much debt for my liking in the portfolios I manage. And because of their debt issues, they are also overvalued when it comes to enterprise value to EBIT, which is one of my favorite relative valuations to look at. So with all that said, I would not be able to invest or continue this research into Ford for the portfolios I manage. But it's still a great case study, Picnicking Pillowcase. Thanks so much for requesting this. If you liked the video, or if I missed something, if I didn't explain something well enough, if I should have explained something better, let me know in the comments below. If you want me to look at a stock like this for you anywhere in the world, I will do so. All videos for the last 5-6 months now, and every video at least for the next 2 or 3 months is requested by a viewer. So if you want me to look at a stock anywhere in the world for you, I will, if it meets 3 criteria. It can't be a bank because I don't evaluate banks. It can't be an insurance company because you actually have to dig into the annual reports to evaluate them. And it has to be producing revenue. Why did it have to be producing revenue? Because I did a couple of videos where I was analyzing stocks for people and they didn't have revenue, because again, at this stage, I don't care what the company's story is. I don't care what they're doing. I don't care about what they say they're going to do. I have to have revenue to evaluate them. If it meets those 3 criteria, let me know, and I would love to look at a stock anywhere in the world for you. If you're listening on YouTube, thanks so much. Really appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. And we'd also appreciate if you do subscribe to hit the notification bell so you're notified every time I release a new video and release new videos all the time. You also, if you are subscribed and hit the notification bell, will be notified anytime we do lives. When we're doing lives, we're trying to do at least once a week. The lives right now on both YouTube and Facebook. And if you're subscribed on YouTube, hit the notification bell. You'll be notified every time we not only release a new video, but we do a live as well. If you're listening to the podcast, again, make sure to do all that same stuff. We really appreciate it. On the podcast, we also really appreciate a review, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific help, or if you're looking for more help on how to become a better investor faster, make sure to check out our free resources at the links below, including our 5 free gifts. You can also get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those at the links below. And if you're looking for more specific help from me on how to become a better investor faster, make sure to check out our Value Investing Masterclass, which is now open. As part of this, you'll learn how to value and evaluate stocks better, faster, more efficiently. You have live group trainings. If you're among the first 10 people sign up, you also get up to $9,000 in bonuses, including our Value Investing Blueprint, which we're going to sell next year for $5,000. You'll get that for free if you're among the first 10 to sign up, and you also get free one-on-one trainings with me as well. Plus all the videos, resources, everything you need to know and learn to value and evaluate stocks better and faster, including where to find them, 23 valuation techniques, all that. But you can find out more about that at the link below as well. Or you can go to mastermind.valueinvestingjourney.com directly to find out more information about that as well. But until next time, have a great day. Talk soon.